everyone, this is Dimo Gonzalez of Heartwood Financial Services. Hey, welcome to our latest market update and outlook video. So I hope everybody had a great 4th. I wanted to keep this with the 4th of July theme going. We're going to talk about a question that's been coming up a lot in my client conversations, and I see it a lot on TV as well. They're talking about, is the U.S. kind of losing its edge, what we're calling U.S. exceptionalism. The market for the U.S. has done really great over the last 15 years relative to a lot of the global counterparts. So is that going to continue, or is there a big change coming around? So we're going to talk about that and what's going on with the market. So let's get started. All right, here we are, the asset class returns for the month of June. A couple of months ago, we were looking at the market and it was looking a little ugly. We were in the middle of a correction, right on the verge of a 20% bear market. So we've had a huge turnaround. What were some of the catalysts? Well, inflation has stayed in check, and of course, a huge Trump tariff kind of delay, pushing it out. And now we're starting to see negotiations take place, so we're starting to see that maybe those tariffs that looked really ugly in April were just a starting point, and they're starting to come down. So the market has looked at this in a lot more favorable light, so we've seen a very nice turnaround. We are in the positive territory now for the S&P 500 at a positive 6%. Had a really nice month here in June. We've seen a little breadth where the small caps are starting to catch up a little bit. Real estate's done okay. But the big story of the year so far has been international. As you can see, developed internationals up 20%. That's huge. That is quite a big of an outperformance over the domestic market, and even emerging markets doing pretty well. Now, they didn't do as well this month, and that's going to be interesting to see if that's a new trend. But overall for the year, it's done very well. There's a lot going on there, but the biggest thing is the dollar has been kind of weak. So international currencies are more favorable, so their markets do a little bit better when you repatriate back to a dollar. Okay? Bonds have done pretty well. The rates have been coming down. They've been up and down, but for the most part, they've been coming down for the year. So that's why we've seen positive returns for bonds. Especially high yield, because the economy is hanging in there and yields have been kind of coming down. And then on the commodity front, it's mostly been a story about precious metals, especially gold, because energy's not going up. It's been kind of going down, actually, especially after this whole thing with Iran kind of slowed down, or at least calmed down a little bit. Energy prices have been coming down. So gold has been going up, and that's because the dollar's been weak. Same story of why internationals doing so well. So let's talk a little bit more about what's going on in the economy and how these different things are affecting the market, and I'll get more into the outlook as well. Let's go. All right, for the market update, I always like to start with what's going on with inflation. As you know, inflation dictates what's going on with the Fed and interest rates, and you know how interest rates has such a big effect on what's going on in the economy and the stock markets. So what I want you to focus on is the core PCE and the headline PCE. Okay, these are the numbers that the Fed looks at the closest. And what they're shooting for is they're shooting for a 2% number. As you can see, the green is at a 2.7 and that orangey color is at a 2.3. So we're getting pretty close. Now, inflation actually ticked up just a little bit last month, but it was a 0.1, which is a very small tick up, so nothing to really get too concerned about. So what we're seeing is that we're not getting a big tariff boost in inflation, which is what the Fed was nervous about. You know, they've been holding off. Trump's been yelling at Jerome Powell, calling him too late Powell, you know, all these jokes, because he's trying to push them to cut rates. But the Fed is just going to look at the data. They're going to look at the fact that inflation's coming down, which is good, but they're a little nervous about the tariffs and what effect that might have to inflation. But so far, it's looking pretty good. They're starting to hint that September is on the table, and the market's actually including 2 cuts. And 2 cuts, remember, they're a quarter and a quarter, so you're talking about 0.5%. And so that would be a nice little tailwind for the market. The market's starting to sniff that out as well. I think that's part of the reason why you've been seeing the market starting to react a little bit better and come up a little bit here recently. All right, so here's the big three report. This is basically the ISM manufacturing, the ISM services, and the unemployment report, which basically almost all came out this week. It was a very busy week. And so what we got here are the PMI manufacturing was a 49. And so if you remember from watching my videos in the past, anything under 50 means that things are slowing down. Over 50, that means they're growing. So we're right at the cusp of slowing down, but it does look like it's going up just a little bit. We're at 48.5 previously, so 49 is a little bit better. Non-manufacturing or services actually kind of popped back up. Last month, remember I said, well, we're getting under 50, so that's kind of an ominous sign if it keeps up. But it looks like maybe it was a little blip. We'll have to see. We're still very close to that 50, so just barely growing, but at least growing. So that's positive. And then the unemployment report was also a slightly positive report. We had a positive 147,000 new jobs, and unemployment went down to 4.1. There's a lot of discussions about why 4.1 went down from 4.2, but we won't get into that in this video. There's not enough time. But basically, last month we had positive 139,000 new jobs. So again, we're seeing an economy that's growing. It's not, growing in leaps and bounds, but it's hanging in there pretty good. And so far, it looks like the Fed has engineered a pretty good soft landing here. The concern is about the tariffs. So once they get past the tariff concerns and inflation, I think the Fed's going to really start to cut, and you're going to see the economy maybe start to also do a little recovery at that point as well. We'll see. All right, and then the other good news was the S&P 500 reaches a new all-time high. So we're back in a nice positive direction. Up above 6% as you saw from the asset class returns in the 6,200 range. So we've had the tariff delays. We got the Fed back in play. And we got the big beautiful bill, BBB, that was just passed over the weekend that could have some tax breaks that could help businesses. And that could also be good for the economy, of course, for the markets. And so I'm still a little concerned, though. July 9th is coming up. That's when all those 90-day tariff delays are coming due. What's going to happen? Are there going to be a little bit more conflict that's going to occur at those deadlines? Are we going to raise tariffs? Is it going to have more of an effect on inflation that we were hoping for? We'll have to see. The other thing I'm concerned about too is that the market's gone up a lot. So when the market goes up a lot, they're anticipating a lot, they're pricing in a lot. So maybe we got a little overdone. We'll have to see. So this is not a time to just throw it all in the risk category. I think this is time to still be a little cautious. But let's get more into the outlook here in the next category of our video. All right, in the market outlook, I want to answer the question that I posed at the beginning of the video about U.S. exceptionalism. Is it over or is it just a pause? All right, have we lost our edge? And so the international markets have done really good. They have more than doubled the returns of the S&P 500 this year. And if you take out how much the dollar has gone down, the international markets have been kind of on par with the U.S. The biggest difference has been the dollar weakness. You can look at this chart here. You can see that in January, we were at about 110 on the Dixie, which is what they call the dollar index, and we're way down here at about 97. That's a pretty big drop. That's one of the biggest drops that we've seen in the dollar really in about a decade or so. So let's talk about what's going on and maybe what's to come with this. All right, so here are the 6 reasons I think the dollar has been going down. I'll go through this real quick, but you'll also see from my comments here is that I think the dollar might be kind of bottoming out here. First of all, I think there was a recent counter trend. You see, a lot of people were way out of line with their portfolios. The U.S. has been doing so well for so long. People got really concentrated in the U.S. and there was a little bit of a snapback coming back to more normal allocations in international. The sanctions impact didn't help, so prior to this recent dollar weakness, we've been having a lot of sanctions on Russia. I think China's been very concerned that they could be next. So they've been selling a lot of treasuries. They've been trying to get a little bit more into gold, and that has been a little bit of a headwind against the dollar as well. And the fiscal responsibility issue, right? $36 trillion in debt. Our income is going up slower than our debt. So that's not a good sign. Of course, that's probably something that we're going to have to deal with at some point. It's not scary bad yet, but it's always on people's mind, and it's obviously an issue that's coming. And the Trump tariffs, that's been tough too, because that could slow down global growth. It could slow down the U.S. growth too, because we're the ones putting tariffs on everybody. Everybody just has to deal with the U.S. We got to deal with the whole globe. So globally, that could be tough for the U.S. economy. So when the economy is a little weaker here in the U.S., the dollar goes down. So that kind of makes sense. That's why I think the dollar's going to probably start to come back, because I think the tariffs that were first feared about at the very beginning maybe were more fear than reality. We'll have to see, of course. But I think that we could be reaching a bottom there too. Section 899 was this proposal in the BBB, the Big Beautiful Bill, that scared a lot of people because it was going to be a big tax. It would be a revenue maker for the U.S., but it was going to be a big tax. And so we thought there could be a big incentive with these other countries to retaliate, and it would keep people from bringing money back into the U.S. So it was actually not a very good idea. They ixnayed the proposal, and so I think what harm was done in the dollar might be starting to come back, as that was taken out and it was not included in the signing of the recent bill. And then, of course, there's been a lot of stimulus in Europe, especially in Germany, where they're spending a lot more on infrastructure. They're spending more on defense spending. That's all been good potentially for their economy. We'll have to see how much of this really happens. Europe coordinating efforts. They don't have a very good track record on that. So I think a lot of this potential stimulus might be a little bit overdone. So again, you can see a lot of these things were building into the dollar weakness, and I think it's probably at the bottom, and maybe we're going to at least plateau or turn around here a little bit. All right, so when we try to decide if the U.S. is still going to be leading the global growth, we got to look at the growth differentials. You can see the dark line is the U.S., and the U.S. still looks very strong. It's been very strong in the past, which is why our markets have done a little bit better. And as you can see here, the projections are for it to continue to do pretty well. The only one that's kind of catching us is China, and I have kind of my doubts about that projection. I think there's going to be some hiccups for them, but their growth has been pretty good too. But you can compare that to the EU and Japan, and just the growth rates just haven't been as good. So that's why I think what we're seeing here is a little bit of a snapback trade. Long-term trends still show the U.S., even though we're a little bit more expensive, we're growing at a much better rate. And finally, you can also see where all the tech stocks are, okay? When you compare the U.S. to the EU, we have bigger tech companies, we have more of them, and frankly, a lot of the growth, not all, but a lot of the growth that's going to come in the future is going to come from technology stocks, especially the ones focusing on the AI revolution, and those companies are here. Now, China has some too, so they're going to do well in that respect, but compared to the rest of the world, especially Europe, the U.S. is going to continue to lead. So I think what we're seeing here is the U.S. exceptionalism is not over. Do you want to own international? Of course, because there's going to be times where there's a little bit of a correction, snapback, and what we're seeing right now could actually persist for a little bit longer until things change here in the U.S. and those 6 trends that I talked about. And so it's important to have exposure to both. But this is why I'm not chasing the returns of international, because the trends for growth are still good here in the U.S. and tech is going to lead, and the tech is here in the U.S. All right, and so what does it mean for Heartwood implications? Well, I'm not making a lot of changes. We participated nicely on this run-up with the market. We did not hide our heads in the sand like a lot of people did, afraid of what the market was to bring us. with the tariff news. So we hung in there. We were neutral. We participated nicely. But some of the changes I'm making, I've been working on, and I'm continuing to do that, is reducing the China exposure. I'm concerned about what's going on with our tariff, we call it tariff war. I know that right now is a little bit of a calm, but I think there's going to be more to come with China. So reducing China, adding a little bit to ex-China EM, and also adding a little bit more to large cap quality. Not quite ready to jump into the small cap yet. They've started to make a little bit of a comeback, but I need to see more progress with inflation and rate cuts for that to be a big story, so we're waiting there. On the bond market, the economy has been hanging in there. Rates have been steady, so we're adding to floating rate, reducing long-term bond exposure. And so when we do that, we're saying the economy is going to hang in there, and interest rates will come down, but they'll come down slowly. And so I think that's pretty much what's playing out. Having a little extra cash, we're clipping nice coupons in the 4% range while we wait for something to happen with rates or with the economy. And so that's where we are right now, guys. And if you have any questions, please feel free to reach out. If you have any concerns, or if you want to talk about your situation and how you're positioned and get some of my thoughts, I'm happy to do that as well. But thanks for watching. Have a great rest of your summer, and God bless. Bye-bye.